This video right here promises to teach you 20 strategies for trading in just 12 minutes. But can anyone actually do that? And also, is trading just about learning every single strategy, or is it actually about knowing which ones work and when to use them? So we're gonna watch this video, see what it has to offer, see what's missing, and see if anything in it could actually hurt your trading. Let's have a look.
Fibonacci retracements. It is a tool that displays horizontal lines based on the Fibonacci numbers. These lines can then be used as key support and resistance levels.
Now, if you're not familiar with Fibonacci, something called the golden ratio, it's actually fascinating, and it's something that you see in nature all over the place. So this is the golden rule, or the Fibonacci number applied to trading, which is just a multiple that you are sort of turning into this repeating pattern.
To use the Fibonacci retracement tool, you first start by identifying a swing low and a swing high on a chart. Then, drag the tool from the swing low to the swing high. Next.
Okay, and if you're in TradingView, I just want to show people how to do this. It's this tool right here. It's called Fib Retracement. So you can locate that in TradingView by just clicking the Fib Retracement tool, finding that, and then you can actually change the settings to however many sort of levels that you want to see.
Wait for the price to make a pullback to one of these levels, ideally the 0.382 Fibonacci level, because that's the most common level where price tends to reverse from.
Okay, so what we have here is a bull breakout, right? This is a bull trend, and he's using this strategy to figure out where to enter. And the idea is that the price will retrace right around here, and you can get in at a much lower price than actually buying up here.
If price touches that level, that could be a good buy entry. Keep in mind that price could also reverse from other Fibonacci levels.
That's also about a 50% pullback, right? Probably not exactly, but if you were to measure from here to here, right here is almost a 50% pullback, okay? So you can actually just do that just by measuring 50%. And I'll show you how to do that in TradingView. If you take your chart in TradingView and you just use the measuring tool, and like, let's say we wanted to measure this guy right here, right? Like, look at a measure from the bottom all the way to the top, and look, the price, this is the midline. Okay, so this will show you where 50% is, and look, we retraced almost perfectly to that 50% level, okay? So 50%, I just want to add in here, also works, and these Fibonacci numbers are just multiples, okay? So you don't have to get too crazy with it. What I want you to do as we continue to move through these strategies is see if you can understand the simple idea behind the strategy, because it's really ridiculous to think that you need to understand 20 different strategies. But here's the thing. If you understand price action, then you can understand the basis, the gist of every strategy. So challenge yourself as you watch this video to see if you can understand what's going on behind the strategy that's actually making it work, because that'll actually improve your trading knowledge regardless of what strategy you use.
Combine it with other confirmation signals to get a better entry. Breakout patterns.
Okay, so we went to Fibonacci. Let's go to breakouts. These are one of my favorites because they're one of the most reliable patterns there is.
It is when price makes a sudden and significant movement towards one direction. This usually forms after the market makes a consolidation period. For example, here we can see that the price is consolidating. Then, it suddenly moves sharply to the downside. This is called a breakout.
All right, now why? Because we broke out below those prior lows.
To take advantage of this, traders could use specific patterns as a guide to identify breakouts before they happen. Most notable breakout patterns includes wedges, triangles, and the rectangle pattern. Reversal patterns.
Okay, so let's go to reversals.
It is when price moves in the opposite direction of the current trend and forms a counter trend. Specific patterns could be identified in a chart, which could help traders predict reversals before they happen. Most notable reversal patterns are double top and bottoms, triple top and bottoms, head and shoulders, cups and handles.
Now, these are the highest probability setups. Of all the setups, of all the patterns, setup is a pattern, this is the highest probability in all of trading. Why? Because this is essentially a pullback. So a pullback is once the price has moved in a certain direction, it pauses, reverses slightly in the other direction, and then reverses back in that direction, which is what you see here, right? We broke out, and then we pulled back, and now we're breaking out again to the upside, okay? So this right here would be where the pullback starts. Or let's look here. Price broke out here, pulled back slightly, and then broke out again. Okay. And let's take the opposite, right? A short breaks out to the downside, pulls back, and then goes back down further in that direction. Okay. So one of the highest probability setups, one of my favorite setups, and pullback setups can have, not always, but can have up to a 90% likelihood of going in your direction, which is extraordinary.
Elliott wave. It is a theory that suggests that market tends to move in a series of 5 waves before reversing and forming another set of waves in the opposite direction.
Okay, so I just want to point out something that I mentioned earlier in this video. Remember, my challenge to you as you watch this video is, can you see the strategy behind the strategy, okay? Can you get the idea that's making this strategy work? And I want you to start to see the connections between all of these 20. Now, we're going to cover 20 in 12 minutes as a tall order, but he's going to do it, okay? So look at this and look at what happened here. Now, if the price moved down here, okay, then what do you see here? You see a top, and you see another top. So that's a triple top or a wedge. Now, let's go back to the prior pattern and let's look and see, oh, look, that's a triple top. Okay, so this is actually the same pattern, but it's just being understood differently, okay? Because he's taking, in the Elliott wave, you can see that they're counting all of these different moves. So it's not just taking this into consideration, but it's taking these into consideration as well. But the top is a top is a top. It's the same idea. So that's the strategy behind the strategy. See if you can start to find these for yourself as we move forward. And if you have questions, pop them in the chat.
Before reversing and forming another set of waves in the opposite direction. By understanding the Elliott wave sequence, traders can predict where the price is heading by following the pattern.
Which, again, reversal strategy, right?
In a chart, we can label each point of the waves as 1, 2, 3, 4, 5, and ABC. Now, there are specific rules to ensure that a movement is considered as a valid Elliott wave. First, wave 2 cannot be longer than wave 1. And usually pulls back to the 0.618 Fibonacci.
Again, look, we're using Fibonacci again, just like I said, okay? So all these different strategies are going to connect. So I want you to start looking for these connections. And also, again, notice 0.6 is about 0.5, right? It's pretty close to 0.5. And this actually, if 0.6 is here and it went down here, it probably went to about a 50% pullback. So same kind of thing. You start seeing the patterns, start looking for the patterns inside the patterns here, looking for the strategy behind the strategy.
Level. Second, wave 3 must be the longest wave amongst wave 1, 3, and 5. Third, wave 4 must remain above the peak of wave 1.
Okay, now why would that be the case? Why would this have to be above here? Because now that's a gap. Do you see this is an open gap? ICT traders, you might call that a fair value gap, but it's just a gap, right? There's a gap between this high and this low. And what does that show you? It shows you that the sellers tried to push the price down here, but there were so many buyers that they defended this area, and they told the bulls here, started buying, and they rejected the bears and said, nope, get the hell out of here. This is bull territory. And they sent the price up. And what that did is it left a gap. And what that shows you is conviction on the part of the buyers or the bulls here. Okay, so that's a key indicator because it means that the price is significantly moving in a direction, which is what you want to look for.
Usually pulls back to the 0.382 Fibonacci level. So here's an example of the Elliott wave in action. In this chart, we can see that the price resembles a possible 1, 2, 3 Elliott wave. And so, based on...
And again, breakout, pullback, continuation, just like we've been saying.
The theory of wave 4, which is that price tends to pull back to the 0.382 Fibonacci level before continuing upwards, we can use this as a potential buy entry when price makes a pullback. Fair value gaps. A fair value gap occurs when a candle forms a significant gap due to an imbalance of buying or selling.
Okay, so there's a gap between this high and this low. There's also a gap between this high and this low, right? So depending on your strategy, there's different ways of drawing these.
To find a fair value gap, you first need to find a candle with a large body. Then, draw a rectangle at the gap. Place it between the previous candle's wick and the next candle's wick.
Right. You could also draw it here, right? And notice that we actually tested this high, this prior high, instead of this prior high.
This level now acts as a potential magnet, where price may revisit before continuing its movement.
Right. So if we wanted to draw this gap before this candle formed, right, then we could say, okay, let's actually watch where this big bull bar broke out of. And notice it broke out of all these highs. And this was the most recent one that we can see. That's the highest one. Okay. So it broke out, closed above this one. And then we could say, oh, look, right here is where it's going to come back and test. So then this candle went back and tested exactly that point. Do you see that? Look at the line. See that? Okay. So that's a really interesting observation. And when you use this understanding, it can help you get entries that are absolutely spot on. So let's see what else there is to learn about fair value gaps here.
Candlestick patterns.
Okay, so that was it. So this is a 12-minute video. We're not going to get a lot of detail.
It is a technique that traders use to analyze future price movements by looking at specific candlestick shapes. Notable candlestick patterns include engulfing patterns, which signal strong momentum towards the direction of the engulfing candle.
Okay, he's calling this an engulfing pattern, right? Why? Why is this an engulfing pattern? Because it's, it's bigger and engulfing the one prior. You see that?
Candle, hammer and shooting star patterns, which indicates rejection
I would just call this a doji, but yeah, we can get fancy with it too.
as shown by the long wick on one side. Doji patterns, which signals neutrality in the market. Heikinashi. It is an indicator that fully replaces a traditional candlestick chart to a Heikinashi chart. When applied, it tends to give less noise than a traditional candlestick. A green Heikinashi candle signals that the price is on an uptrend, and a red Heikinashi candle signals that the price is on a downtrend. The size of the candle's body also indicates how strong a trend is. The larger the candle, the stronger the trend. Keep in mind that the Heikinashi only acts as an indicator. It does not display the real market price. Moon phases.
Moon phases.
It is a concept that utilizes moon cycles to time the market.
This is not a joke, people. This is not a joke.
Moon phase traders believe that moon cycles are correlated with human emotions and behavior, which could have an influence on the market.
What's kind of fascinating is like you can see it actually kind of works. Okay. It actually kind of works, which is kind of cool.
With human emotions and behavior, which could have an influence on the market. Specific moon phases are believed to be favorable towards a certain trend. A new moon means the market tends to be bullish, and a full moon means the market tends to be bearish. Today, it is used mostly as a confirmation tool. Renko.
Okay.
It replaces a traditional candlestick
I should change the name of the channel to Full Moon Day Trader. And just that's all I'm going to do from now on.
chart to a Renko chart. So, unlike a traditional candlestick which forms a new candle based on a certain period of time, a Renko chart forms its block based on the change of price. For example, every 1% change in price, a Renko block appears. This means that each Renko block represents a 1% change in price. Of course, you can change the parameters of this through the indicator settings. Traders could utilize Renko charts to filter out noise and identify trends.
Okay, I just want to say, there's no such thing as noise in trading. I'm a student of Al Brooks and I learned this from him. There's no noise. If you really think about it, there's no reason why anyone would ever execute a trade for no reason. There's one reason why anyone ever executes a trade. It's to make money. And there's a reason why they're executing that trade, whether that reason is valid or not. So all trading is logical and rational for that very reason, which means there's no such thing as noise. So the problem with saying something is noise is really, you're just actually acknowledging there's something you don't understand. So see if you can not say that, right? See if you can not say something is noise, because if you say it's noise, you're just actually pretending that there's nothing there that's rational or logical, but it's not true. So that's something you want to listen for. And also, if you think something is noise, like it's just random, actually study it so you can learn and understand the logic behind what's actually happening. That's a much better attitude than, oh, filter out the noise.
A green Renko block signals an uptrend, and a red Renko block signals a downtrend. And keep in mind that Renko charts only acts as an indicator. It does not display the real market price. Harmonic patterns. These are advanced price patterns that follows a specific shape based on Fibonacci numbers. Traders can then use these specific shapes to predict future price movements.
Again, so harmonic patterns, going back to strategy number one, Fibonacci, it's using Fibonacci numbers to come up with a pattern of how those numbers show up, okay?
For example, A bullish bat pattern is formed when price makes a series of 4 movements that is shaped like the letter M. Each point can be labeled as X, A, B, C, and D, and each of these points has a specific guideline. For example, point X to point B needs to have a value between 0.382 and 0.5. Point A to C needs to have a value between 0.382 and 0.886. And the same thing works for the other points. Next, these specific guidelines can then be applied onto a real chart. So, if you see a price forming a series of 4 movements, you can apply the harmonic pattern tool to check if the price that formed matches a pattern's guideline. If it does, then you can take a position based on the pattern that formed. There are multiple harmonic patterns that exist. Most notable are butterfly, bat, crab, and each have their own unique values.
Okay, this is where we get into some pretty ridiculous SHIT, okay? So yes, you can come up with all kinds of fun little animals if you want. If you really want to have fun with it, I got no problem with it, having fun with it. But here's the problem I have with the strategy like this. You're insisting that the market fits these very, very rigid criteria. And you're not going to take a trade with this according to these rules unless it fits this very, very rigid criteria. Now, as I said, there's nothing wrong with that. However, if you don't understand what's happening here, like you're going to be at a major loss, okay? Because what's happening here is a double top, right? Remember we showed you triple tops earlier? Showed you triple tops earlier, right? Remember that? We were looking at breakouts and then we went to reversal patterns and we showed you this triple top or a wedge, okay? So these are basically 2 double tops within each other, okay? And then you got double bottoms here or a triple bottom, okay? You can see it different ways, but you've got a bottom and you've got a top, okay? So if you don't understand this first, then you're going to be very confused when you start trying to understand something like a harmonic pattern. And what I'm arguing here is that you want to focus on what's the actual strategy behind the strategy, okay? And the strategy behind the strategy, in the case of a harmonic pattern, well, let's see what we can learn. We've got a top here, okay? So we've got a top here and then we've got a bottom here. You see that? So look at the tops and the bottoms and look at learning how to identify tops and bottoms. And once you understand that, then you can start to understand all patterns.
And 0.886. And the same thing works for the other points. Next, these specific guidelines can then be applied onto a real chart. So, if you see a price forming a series of 4 movements, you can apply the harmonic pattern tool to check if the price that formed matches a pattern's guideline.
And remember, he took a buy order down here, right? He took a long position down here. Now, if I look at this and I'm just trying to understand this in very simple terms, I would say, well, look, this is a trading range because we went up and then we retraced almost the entire move. And in a trading range, look at what buyers and sellers are doing. They're buying at the bottom and they're selling near the top. So if I see this pattern, I'm going to be considering getting long down here because there was buying and there was a bottom, right? So I see a bottom here and a bottom here, and I go, man, it looks like we are trying to make another bottom here, and I'll look for an indicator that the price is indeed reversing there and consider getting long. That's one way to look at it as well. So see if you can understand the strategy behind the strategy here.
Then you can take a position based on the pattern that formed. There are multiple harmonic patterns that exist. Most notable are butterfly, bat, crab, and each have their own unique values. Support and resistance. These are key
Okay, now this is one of my favorites here.
levels that formed horizontally where the price has bounced off in the past and could possibly bounce again in the future.
The reason why I like this strategy is because it's very easy for a beginner to be able to identify these things. And when I was first starting out, this is one of the things that I started to be able to identify right away. So you can see, look, you could just draw a line there because the lows are all bouncing up and reversing around the same area, right? Same here, right? I was just looking at this earlier before starting this video, right? Look, you've got a top here. So you could identify that area and then look at where I drew this area here. See, the price was moving up like this, and I noticed that there was an area of support here. Support and resistance are magnets. So I'm like, the price is getting sucked up to this area, And then look what happened. The price now is getting sucked up to this area. So we can draw another resistance area in this case, and we'll make it green for, or sorry, we'll make it we'll make it red for resistance, okay? Because there'll be likely be sellers up here. So if you're a beginner and you're just starting out, okay, can you just look and say, okay, look, there looks like there's a top there. And if you move to the left, oh, there's a top here too. So if you start to see one top, two tops, three tops, then you can start to learn very simply how to identify these resistance areas, whether it's at the top of the chart or it's near the bottom of the chart, okay? So start, if you're new, start to look for support and resistance areas, because that's one of the best ways to start to train your brain how to identify these patterns in real time.
If the level is below the price, it's called support, where you can take a buy position if the price approaches it. And if the level is above the price, it's called resistance, where you can take a sell position if the price approaches it. Dynamic support and resistance. Similar to support and resistance, dynamic support and resistance also acts as key levels, but instead of using static horizontal lines, it uses indicators like the moving average to act as our key level. Trend lines. Trend lines are key levels that form diagonally during a trending market. You can use trend lines to identify the overall direction of the price. Upwards trend line means bullish, downwards trend line means bearish. And similar to support and resistance, you can also use the trend line to identify possible entry scenarios. For example, if price retraces back to a trend line, it can be a good opportunity to take a buy position.
Do you guys see, I just want to point something out. Do you guys see how that's very much the same thing? So we're having different names for basically the same thing. He's calling this dynamic support and resistance. But do you see how the moving average here, let's assume this is the moving average. Do you see how he's calling this dynamic support and resistance is the same thing as a trend line, okay? He's drawing a straight line here, but here it's a wiggly line, okay? But it's the same idea. It's the exact same concept, okay? So I just want to point out here that if you understand support and resistance, which we went over first, right? Resistance would be at the top, support would be at the bottom. If you can understand that, where there's sort of little clusters of areas where there were buyers, little clusters of areas where there were sellers, and you can start to identify those areas, knowing that they're areas, not just a line, but an area. Okay, that's a key and important point. Then you can understand what dynamic support and resistance is, which is using something like a moving average, which every trader, I believe, should have some type of moving average indicator on their chart. And then if you understand dynamic support and resistance, then you can understand trend lines. You see how they're all starting to connect?
Bullish, downward trend line means bearish. And similar to support and resistance, you can also use the trend line to identify possible entry scenarios.
All right, I liked it. Now I like this video. Hit the like button. I hit the like button for him. You hit the like button for me if you like this video.
For example, if price retraces back to a trend line, it can be a good opportunity to take a buy position. Gone angles. It is a tool that displays multiple lines that spread continuously on different angles.
This looks like Tori Trades' chart.
These lines can then act as possible key levels and could also help you measure the strength of a trend. Price moving within the steep angles of the tool indicates a strong trend, and price moving within the shallow angles of the tool indicates a weak trend. To apply the Gann angles, first you go to Settings, then make sure to check the lock price to bar ratio. Next, identify a market range and mark the swing low and the swing highs of that range. Then, draw a straight vertical line at the start of the range. After that, select the trend angle tool and measure 45 degrees. Then, use the Gann fan tool and place it at the 45.
See, already I'm bored. Already on board. It's too complicated. It's too complicated. But okay, let's keep going.
45-degree angle. Momentum indicators. These are the types of indicator that measures the direction and strength of a trend. It is most effective when used in trending markets. Some of the most notable momentum indicators are MACD. An upwards crossover indicates a bullish trend, while a downwards crossover indicates a bearish trend. Moving averages. Price being above the moving average signals a bullish trend, and price being below signals a bearish trend. Parabolic SAR. A dot below the price indicates a bullish trend, and a dot above the price indicates a bearish trend. Supertrend. Green signal indicates a bullish trend, and a red signal indicates a bearish trend. Oscillators. These are the types of indicator that displays the relative strength of a price. It is most effective when used on choppy or sideways markets. Most notable oscillators include RSI. When the line is in the oversold region, it indicates a possible reversal to the upside. If it's in the overbought region, it indicates a possible reversal to the downside. Stochastic. If both lines are at oversold, it signals a possible reversal to the upside. And if both lines are at overbought, it signals a possible reversal to the downside. These two lines can also cross over each other to predict future price movements. Divergences. Divergences occur when an indicator displays an opposite signal of the real price movement. When this happens, it is usually a sign that the trend might reverse. Divergences could occur in many indicators such.
Okay, so I just want to point something out here. Do you see how this is just, if we connected a line, and he actually has the line drawn, right? If you connected a line and we drew a trend line and we started with this low and we connected this low, okay? And then we connected this low. So we drew the line, it would probably go through here a little bit, and you extended that line all the way out to here. Look at where the price reversed, right where that trend line would have led us, which shows you that traders are using trend lines, and institutions, whales, smart money, whatever you want to call it, are using trend lines and buying along that trend line, okay? So if you don't understand something as basic as trend lines, then you shouldn't even be considering divergence or a strategy like that, because you have to understand, as I said over and over again, the strategy behind the strategy.
Such as the MACD, stochastic, and the RSI. For example, here, using the MACD indicator, you can see that the price is forming higher highs, which is bullish, but the indicator shows the opposite, a lower highs, which is bearish. In this case, this is a bearish divergence, which signals that the price may form a reversal, and so you can take a sell position. Volume indicators. These are types of indicator that shows the strength behind a price movement by tracking the trading volume.
Okay, boom, double bottom, right? Boom, boom, bottom there. So there we go. We identified that pattern. Let's see if we can identify any other patterns.
Volume indicators. These are
okay, look, double top right here, right here. Okay, so double top, double bottom. So quickly, your eyes need to be able to identify patterns like that before you get all caught up in using these indicators.
Types of indicator that shows the strength behind a price movement by tracking the trading volume. Notable volume indicators include price volume, which displays the volume for each candle. The longer the bar, the higher the volume. Volume weighted average price, which shows the ratio of an asset's price to its total volume.
Basically, almost identical to moving average. Average price, AP, average price.
It can be traded like a moving average or as a dynamic support and resistance. Volume profiles. It displays a volume bar horizontally, which can be treated as key levels for potential entry positions. Supply and demand. Also referred to as order blocks, these are zones where significant price movements have occurred. If price moves significantly upwards from a level, it is considered a demand zone.
Okay, but then also notice here, we've got a double bottom here because we had a bottom here. So it's a double bottom, and then we've got a triple bottom. Okay, so we call that a wedge bottom. 1, 2, 3 times. The price came right down into this area and bounced out. So we came down into this area, bounced out once, came down into this area, bounced out again, and then came down into this area and bounced down again. So until you understand how to identify a triple bottom, don't even waste your time on something like supply and demand.
And if price moves significantly downwards from a level, it is considered a supply zone. Just like support and resistance, these zones can be treated as key levels for potential entry positions. Market structure. Market structure is when trader analyzes the behavior, condition, and flow of the market. An uptrend structure is characterized by price forming higher highs and higher lows, while downtrend structure is characterized by price forming lower highs and lower lows.
This is one of the most important ones, so pay attention to this. Okay, that's it. So that's all he included. Okay, so I would just add some detail here. 2, there are 2 different structures. There are 2 different basic structures in every chart, every time frame, whether it's crypto, Forex, futures trading, stocks, whatever. Okay, you've got trending markets and you've got ranging markets. Trending markets and ranging markets. So you need to be able to, those are the 2 different structures. You with me? So you need to be able to look at a chart and be able to see whether or not the market is trending or ranging. So ask yourself, look at a chart and see if you can challenge yourself to say, okay, is the market trending or is the market ranging? And if you want a very simple, clear test here, okay, I'll give you a very simple, clear test. Look at this chart and tell me, where's the trading range? Where's the range? And where is the trend? Okay, because on this chart, they're both market structures are on this chart. So I want you to see if you can point them out. So I'll give you 3 seconds. Look at the chart and see if you can identify with your eyes, where is the trending market structure and where is the ranging market structure? And then here we go. Okay, so there's the trading range. We're ranging here. Why? Because in a trading range, we go down and then up and then down and up. We bounce around inside this range. Okay, it's kind of boxed in. And then trend is there. Okay, so those are the 2 different market structures that all charts have. And before you get into 20 different strategies, make sure that you understand the difference between those 2 things.
Break of structure. It is when price breaks the previous price peak during a trend. For example, if the price forms a higher highs and higher lows, this break of the previous highs is called break of structure.
That's also a breakout.
Change of character. It occurs when price breaks the previous structure during a trend, often signaling a reversal from that current trend. For example, if the price is forming higher highs and higher lows, then it breaks the previous lows forming lower lows. This is called a change of character. So, did I miss any strategy?
No, but here's a few things you missed. So I want to point out a few things that this video misses. Number 1, this doesn't tell you when to use these strategies. It just shows you how the strategy works. That is a major flaw, because if you don't know how to use the strategy in terms of the timing, then you're going to be misapplying the strategy, and that's going to be a disaster, okay? So don't just understand the strategy, understand when and where to use them. When and where to use them. In other words, the question that this video completely left out is, in what market condition does this strategy work best? So that's the first thing that's missing. The second thing that's missing is there's too many damn strategies here, okay? I could boil down, this was 20 different strategies. I could boil down, you could see it. We could boil down these 20 strategies into probably like 10 or less, okay? So you don't need to understand 20 strategies. What you need to understand is what's underneath the strategy that's making it work, okay? Another major thing missing from this video is there's no talk at all about risk management. And risk management is your number 1 job as a day trader, okay? So you need to know that your risk management is actually far more important than any strategy that you could ever apply, because if you don't manage your risk properly, you won't have any money left to apply any strategy. You get me? Now, the next thing missing here is that every single example he gave was cherry picking a perfect trade. Okay. And there's no perfect trade. So what I would have loved to see instead is an example where he showed the strategy applied, but then also when the strategy didn't work and what to do about that, right? It's very easy to just pick perfect examples of every single strategy, but life doesn't happen and charts don't happen in perfect expectation of what you think, okay? So oftentimes there's small differences that show up, and it's kind of like melted plastic. That's what Al Brooks says. There's kind of like melted plastic, if you get it, right? It's like it looks like what you're looking for, but it's slightly different, okay? So I would have loved to see some of those more melted plastic examples, and then him explain how to actually still apply the strategy in a real life example where it doesn't exactly fit perfectly. And here's the real flaw with a video that focuses only on strategy. There's no talk about trading psychology. Okay? No talk about trading psychology. And if you don't have some sort of strategy to manage your mind and emotions while you're executing your technical strategy, you got no chance. If you want to learn how I trade, I'll show you the 3 patterns that I look for, how I manage my risk, and how I set my profit target so I can get out before it's too late. If you want a downloadable PDF with those 3 things broken down for you, hit the link in the description. It's tradesbybren.com, and I share those with you for free, including a 15-minute detailed training showing you real examples on the chart. And if you like the video, hit that like button. And if you subscribe, you'll get more videos like this. Also, if you're curious about the tools I use, like this one right here, TradingView. Okay. So this is my favorite trading platform, and all the other tools I use, hit the link in the description. I've included those for you as well. Thank you so much for watching. I'll see you next time.